We have $30 trillion of national debt, but we all know it's way more because of unfunded liabilities, et cetera. Okay, what does that mean? Who are we in debt to? This fact that the Federal Reserve, an own quote branch of our own government, is one of the owners of the debt, that is where it just gets really weird. And that's why I say it's kind of just this bogus accounting trick. This idea that the government is going to pay back the debt is kind of a mirage because there's nothing to pay back. As long as the world wants these dollars, because we can continue to produce them and supply the world with what it wants. The debt can't be repaid. It's not supposed to be repaid. It never will be repaid. All right, hey, what's up, everybody? Welcome back to Remnant Finance. This is another solo episode talking more about central banking along the theme of know your enemies. And y'all, I take that concept seriously. I feel like I've read almost everything there is in the IBC footprint. I listen to every IBC podcast that I know of. I am continuously taking in content around our philosophy, our paradigm on money, on capital. But I don't want to get so scope locked on that because I believe that our criticisms are correct. And I believe that we have identified the problem very accurately. But again, if you just continue to live in that, you know, the way that we talk, the assumptions we make, you get in such a almost an echo chamber. And I think it's very, very important when we're talking about something as important as economics to understand what we're up against. That was the 3-part series I did that came out a couple weeks ago called Know Your Enemy. And this is more of the same. So what I want to talk about today is the national debt. I want to talk about treasury bills, the dollar, a little bit more on the dollar as a reserve currency, but I've gotten some questions, and I would shout out one of our listeners and clients, Noah Hart, who has been asking some good questions. And I asked him to elaborate a little bit more on this idea of the debt. And this stemmed from my take that the pressure that President Trump is putting on Fed Chairman Powell right now to lower interest rates, I think is a really bad idea. And the reason I think that is because we have this opportunity to go through this fever break that we continuously talk about on this podcast. The idea that the deadwood has built up, the fever has built up, the toxic load. We need to change something because we're getting to a critical point. Now, when we say that, in the last Know Your Enemy episode I talked about government solvency and how if we don't get spending under control and the interest on our national debt surpasses every other spending category, like this thing can continue to spiral. The point I'm going to make today, the counter argument that I'm going to make is from the perspective of someone who's very knowledgeable as far as macroeconomics goes. And honestly, he's more in the modern monetary theory school of thought, which I don't agree with at all, but he is my favorite economist because, again, it's Michael Hudson, who I've talked about before on the podcast. He explains the financialization and how we've been swept up into this frenzy of banking and financialization of our economy, which has gutted our industrial capability. It's why everything is overseas right now. It's kind of like this whole tariff conversation is the logical conclusion of what we've been doing as far as financializing the economy. Our primary export is debt. The primary asset on our balance sheet is student loan debt. Like, we are just a debt economy, but to some, that is not necessarily a bad thing. I think it is, and I think we need to reverse course on this. But the question came up of, is Jerome Powell just being obstinate here and trying to sabotage Trump's economic plans, et cetera? And I don't think so. I think that Powell is making the right move by continuing to hold interest rates where they're at. Now, things are changing at breakneck speed right now. So when this comes out in a couple of weeks, maybe things have totally changed. As it stands right now, April 21st, the Fed is holding these rates steady, and Trump is urging them to lower them. But I think what lowering them would do, in light of what they're trying to do, the stated goal of this is, hey, this debt, in the same vein as what we've been saying, is that, you know, this interest on our national debt is going to get larger and larger and larger. Therefore, if we lower rates, the interest due on this outstanding balance is going to be lower, right? We all know that if you have $100 and your interest payments coming up, it's about to compound. If it's at 3%, that amount that you owe is going to be less than if it's at 10%, right? That's easy. So I get the goal of, we want the interest rate lowered so that our annual debt servicing, paying out the interest, is lower and therefore more manageable. However, the other side of that coin, if that's going to work, if you're going to assume that that's going to work, the other part of it is the part that is clearly impossible for Congress, which is to stop spending. What you're doing when you lower rates is the same thing that the Austrian School of Economics says, which is lower rates equals cheaper money, equals malinvestment. It equals people pouring money, borrowing money they shouldn't borrow, or they wouldn't if they had to accurately price that money. It also leads to making investments in projects that would not otherwise be invested in because they didn't have the underlying financial strength. And so this idea, the boom bust cycle that Austrian economists have identified, we're clearly coming up on the bust of that because we've had decades of cheap, easy money. And so to lower the rates right now, I think would accelerate that aspect of it. If we think of everything I'm talking about is going to be greatly simplified, and any professional economist might just be banging their head against the wall. But I would be very grateful if there were any professional economists listening to this, and I would love to talk more. But I see it as two different inputs here as far as will this plan work. One, okay, yes, you lower the interest rates, the amount we owe on our national debt would go down, and that would contribute towards the stated goal of reducing this interest and getting back to government solvency, which we talked about in the last part 3 of the Know Your Enemy series. However, if you do that and you don't put any brakes on Congress and you say, well, you continue to do your thing, you're separate, we're going to lower the rates. Now the rest of the economy can continue this boom cycle, continue to grow without the justification of the underlying strength and financial stability. And Congress is going to keep spending. And so it's like there's those two input factors. One of them, yeah, the interest might go down, but if the total debt, if the total expenditure goes up, and remember, Congress says, here's how much money we want this year. The Treasury sells T-bills around the world and domestically. And then the Fed comes in and backstops and buys what they can't sell. We're going to talk more about the mechanics of what that means and who actually owns this debt. Who do we owe it to? That's always a question. Who do we actually owe the debt to? If the whole world's in debt to each other, who do we owe the debt to? We're going to uncover the answer to that. But if the balance, so that example of the 3% versus the 10% on your $100 that's coming due, yes, the 3% would yield a lower interest rate, but that could be overcome if we increase the debt from $100 to $120. There's a point where the two interest rates that we're considering in this very simple example, 3%, 10% on $100 is $10 of interest, right? Well, the 3% could also be $10 of interest at the right, obviously at a higher amount than $100. If you only input one side of it, it's not going to work. You're not going to achieve this goal of reducing the national debt. And it's not even that. They're not going to reduce it. And I'm going to make the case here why they're not going to reduce the national debt, but why they want to at least lower the interest payment. That is a worthy goal, except we know they're not going to stop spending. We even know Trump's not going to stop spending because all of the Doge cuts, everything that was like, I was excited to see. I think all of our listeners were excited to see. This is awesome. They're cutting out this waste. And then all of a sudden, instead of cutting the DOD budget in half, which is what they should do, which is what Trump said on the campaign trail, now we have $1 trillion DOD budget that they're bragging about. So like, they're not going to stop spending. Trump's not trying to stop spending. All of these Doge cuts seem to be just going to be moved from this wasteful basket to another wasteful basket, but one that, quote, patriots are more supportive of, which is just blind support of the military, right? $1 trillion defense budget is preposterous, but that is what they're bragging about. And so, no, I don't believe that they're going to reduce the overall balance of the budget because they're celebrating increasing it. Okay. So that's my take on why we should not lower the interest rates right now, because doing that is going to, you can bring it from 10% to 3% in our example, but if the $100 keeps growing because there's no check on spending, it's not going to work. And so that was the case I made, and that led to some questions, and Noah and myself had a little back and forth discussion about, because I said, hey man, what other questions do you have about this? Because I'm reading from some source material. I consider this the penultimate opposite side. This interview that I'm going to cite, it's a recording, but I read the transcript and then I've watched the interview several times. One of the people being interviewed is Michael Hudson, who my bookshelf is full of his books back there. And I don't agree with him on a lot of the social stuff. And I don't agree with him on the, it's like, I think economically he's spot on. And then you tie in all of this social element, social, I'm not going to say social justice in his case. That's not how he talks. But it is this idea that we are over financing the economy to the benefit of Wall Street, which I believe, and therefore making all of, like the 99% worse off, which in a sense is true, but just the way it's always, it's kind of like a victimy way that it's always framed. And again, not by Hudson. I think Hudson's the man, but the other person being interviewed is an open communist, Richard Wolff. He is an avowed Marxist. And so he is a professor of economics as well, with the background from Harvard and Yale and Stanford, I believe. And he is, for him, it's like everything goes right into orange man bad, and these poor black and brown people, like, we're just, exploitation, all that stuff. He makes some interesting points on the economic side, but again, the takeaways from those, I think, where I stop listening to him is as soon as it stops being about economics and starts being about social causes. I don't have any interest in listening to him, except he does explain some of the things well here, and I'll cover a little bit of that. So here's the questions that Noah asked or said would be good to have covered. I'm going to read the questions. I'm going to go through a few key points, and then I'm going to read from the transcript of this interview. And remember that the transcript is him talking in a recording. So the transcript has, his speech with all of the pauses or whatever. So it's not a perfect transcript. So I'm not going to actually post a PDF of it or anything, because it's just an audio. It's a transcript of an audio recording. But I'm gonna kind of read through it, interpolate it, and then I'll give my input on that as well. And then I'm gonna circle back to Noah's questions and see how we answered them, and if any of them make sense. So here's some of Noah's questions. So what incentivizes foreigners to buy our treasuries? What did they pay with originally? Was it their native currencies? Are these purchases limited to nation states? Can foreign individuals, foreign companies, who's actually buying these? Does foreign governments owning treasury bills pose a national security risk? Is there an amount that you could spread it out to where there's not this threat that could be undermine the dollar by any kind of coordinated action? What's the purpose of passing the debt ceiling legislation? Why is it a political talking point to reduce the national debt? Why do we call it debt if it can't be paid back? What would the unlikely end game look like if they were actually to start reducing the debt? And the overarching question, he said, is, if I had to sum it up, what is the threat of this national debt? I think that Hudson makes a compelling case for this. Even myself viewing it from the other side, I think that his points are very accurate and something we need to consider. We need to remove ourselves from kind of the IBC and the Fed sort of utopia mindset of what could be, and going back to what I said before about what it will be, either what we have or this European central banking nightmare, which is way worse. If I'm correct, and if Joe Withrow is correct, and his position on it, I think is spot on, that one of these two will prevail. And we certainly of the two, while we want ourselves to begin the process of severing our dependence, what happens in Washington, what happens between central banks around the world is out of our control. And because we don't really get a say in that. And so, all we can do is understand it and try to read the tea leaves correctly. Most importantly, it's just having a foundational knowledge of this, because that is a great question, and one that you don't think of. Yeah, we have, $30 trillion of national debt, but we all know it's way more because of unfunded liabilities, et cetera. Okay, what does that mean? Who are we in debt to? That is a fantastic question that I think a lot of people haven't thought through. So a couple key points that I want to start with, and then we'll elaborate using Michael Hudson's words, is that you're not supposed to understand this. This system is built for you to be dependent on the market. You're supposed to go into retirement stressed out and hoping that things work. The market needs to cooperate. And so that is like the foundational cornerstone of what we try to break in implementing infinite banking, in talking about finance and capital the way that we do. You are not supposed to understand any of this, how money works. It's supposed to be extremely complicated. So when we look at what the government debt is, if you look at a balance sheet, assets must equal liabilities, right? So if it is a debt for us, if it's when I say us, I mean the U.S. government. If it's a debt for them, it must be an asset for somebody else, right? That's basic accounting. Government debt is an asset for those who hold dollars and treasuries. What does that mean? You have dollars in your wallet. You have dollars in your bank account. That means you are a creditor to the U.S. government. Okay. Now, we're going to peek behind the curtain here and we're going to see that there's nothing on the other side of the curtain, which is why I'm going to say that the debt will never be repaid. It can only continue and grow. It can't be repaid. And we'll parse through what a theoretical repayment of the debt would look like. But we are the creditors, the foreign governments who hold treasury bills, the investors who buy treasury bills, us who buy treasury bills online. You know, we can go to treasurydirect.gov and buy treasury bills. The dollars that you have in your safe, in your wallet, in your bank account, those are all debt notes. It's a Federal Reserve note. Like it is issued by, quote, our government, the Federal Reserve. And then I think Richard Wolff has a good point on the Fed being part of the government, even though we know, we always say that it's not. But those dollars, all those dollars out there, the massive dollars out in the world, the massive treasury bills held by central banks around the world, the treasury bills held by investors around the world, that is our national debt, because we are the debtor in that and they are the creditor. It's our debt. It's our liability. We owe them something. It's their asset. And the one key takeaway, the 1 point summary here is those are never expected to be repaid. And we'll get into why. So government debt's an asset for the holders of dollars. And assets must equal liabilities on the balance sheet. For every debt, there's someone holding that debt for whom it is an asset. So to pay off the interest on the debt would be to fulfill that obligation to those asset holders, right? If I have a bond, a corporate bond, corporate paper, as they call it, I have a bond issued by whatever, name a company that you might invest in via a purchase of their corporate bond. You have that bond and they pay you interest on the bond. That's the coupon rate. That's an asset for you, right? You're an investor in that company. Now, we always think of investing as stocks, but stocks are a sliver of the actual financial market. The bond market is the dominant force. The bond market is, the stock market's like a drop in the ocean compared to the bond market globally. And so we think of the stock market, but let's think when we talk about investing, most companies, most countries are investing in the bond market. Again, because everyone else besides us values security, safety, and guarantees. We're told to gamble. We're told that the risk equal, the high risk, high reward. Like we're told all these things that keep us dependent. Corporations don't have the same, fear of that we do when we're dependent on the market. So paying interest on the debt is fulfilling the obligation to those asset holders, those who own the treasury bills, those who own dollars for whom it is an asset. So to stop paying the interest would be to default on the investment of the holders of that debt. Okay, I'm not going to quote Richard Wolff much because I find citing and crediting to an open communist is like antithetical to everything I believe. But when he described this process, the relationship of the Treasury and the Fed, this kind of incestuous relationship, I think he described it accurately. And when he described this idea, his takeaway at the end of this was, if you actually understand what's going on, if you actually see how weird this is, you're probably a communist. And I don't buy that because I'm not a communist. However, I do think that it is weird. And here's how he described it pretty succinctly. When the Treasury issues debt, an IOU, to an investor, it then sells a large part of that to another branch of itself being the government, which is the Fed, which has the right to print money, which uses the money it prints to buy the debt of the other part of the government that it is. And as he says, that is weird. That should strike you as weird. Now, he says that the Fed is a part of the government. We say the Federal Reserve is not federal. It's a private entity. It's not federal and has no reserves, right? Now, that's true in a sense. Like it's not a chartered branch. Like it's not a cabinet branch of the federal government, like the Department of Education, like the Department of Labor, like the Department of Transportation. It's not a chartered cabinet branch of the federal government. However, it was put into place by federal law. The Federal Reserve Act of 1913 established the Federal Reserve System as the central bank of the United States. with the express aim of providing the nation with a safer, more flexible, more stable monetary and financial system. Now, I'd say they failed on that account, but the law sets out the purpose, structure, and functions of the system, as well as outlining the aspects of its operation and accountability. Congress has the power to amend the Federal Reserve Act, which has done several times over the year. The Federal Reserve Act is actual legislation. And so to say that it's totally separate, it's just a private company, like it could just be Motorola or Apple, but it's a private company that just happens to be our central bank. Like it's not that separate from the government as we sometimes make it out to be. It has a federal government charter to be the central bank. Now it is owned by other banks. They are the shareholders in it. So it is private in that sense. It's not part of the government in that, I understand the whole case there. And I think everyone listening for the most part probably understands that the Federal Reserve is not part of the government, but also in a sense, it is chartered by an act of Congress. It is to a degree part of the government in that they were granted rights by our government. And so again, whether or not that you want to call it part of the government or not, at the end of the day, they have this very, very structured relationship with the government. And so I'll read Richard Wolff's quote again, and not quote. I mean, I'm summarizing his 2-minute long rant here, but when the Treasury issues debt, an IOU, i.e. Treasury bills, to an investor, i.e. you, me, foreign governments, central banks, foreign investors, domestic investors, corporations, both here and abroad. It issues an IOU to an investor. It then sells a large part of it to another branch of itself, which is the Fed. So that part that doesn't get bought up by investors goes to the Fed, which has the right to print money. So the Fed says, yeah, you didn't. And this is an example I gave earlier in the series. Treasury says, hey, we need to come up with $100 for Congress for the year, and we sold 60 to other investors. We need you to come up with the remaining 40. And so they just print the $40, and that circulates into the economy, through its direct dealers and through a whole process. But eventually, that money is created and goes into the system. So it sells a large part of it, the debt, to another branch of itself, the Fed, which has the right to print money, which uses the money it prints to buy the debt of the other part of the government that it is. He is correct. That is weird. I don't think he's correct that if you understand that, you're a communist. But that is a pretty accurate overview of this weird incestuous relationship, and it should strike you as odd. But what we need to understand here, the summary of these key points, is that for it to be a debt on the balance sheet, it's an asset to somebody else. So how much of the debt borrowed by our government is borrowing from itself, from the Fed? The office across town that prints the money. It's supposed to be confusing, but those two buildings are both in DC. One of them issues debt to around the world and domestically, and the other one says, okay, we'll buy the rest. And so dollars are, we know that dollars, each one says Federal Reserve note on it. They're creating that. That is their product. That goes back to the Treasury, which then goes to fund Congress and then circulates out into the economy. So these two entities are intertwined in a way that is pretty much inextricable, unless it was we totally dissolve the Fed. And again, that gets into the conversation and the point that Joe Withrow made. So with that in mind, let's go to some of what Michael Hudson said. I'm going to read this again, this transcript, and I'm going to jump over, just where the transcript picks up either repeats or if he goes back, because it's directly what he said. And so it's not going to be a verbatim quote, but I think the points will get across. He says, I want to put this debt issue in perspective. And in order to do that, I think it's necessary to think in terms of balance sheets. In one way or another, it's a question of whom. To whom does the U.S. government owe its debts? And I want to make 2 points clear that should always be made at the outset of any discussion. First of all, nobody ever got in trouble by running into debt itself. The problem is having to repay it and to pay its carrying charges if you can't pay it down. I'll explain later. The government has no intention or likelihood of having to pay a large part of its foreign debt. So that idea that having debt isn't necessarily a bad thing, it's not going to get you in trouble. It's the carrying charge, the carrying cost, it's the interest generated and your inability to pay it back that can get you in trouble. Most investors, like Robert Kiyosaki talks about how deep in debt he is, and that's printing him millions and millions and millions, probably billions of dollars at this point. So not having the ability to pay it back, the rate at which it's growing, like that's where you get in trouble. But this idea that the government is going to pay back the debt is kind of a mirage because there's nothing to pay back. So Hudson says the second point that's important to start with is to recognize that one party's debt is another party's asset. The government debt is a preferred asset of most of the economy. So let's look at who holds the government debt as an asset. Well, with all of today's gloom and doom talk, it may surprise most people to say that the U.S. debt is perhaps the most desirable financial asset on the planet. That's why so much of it is owned by the wealthiest layer of the U.S. population. And that's because nobody expects this debt to have to be paid at a cost to the government. That may be surprising, but it's obvious when you think about it. The paper money that you carry around in your pocket is technically a government debt. Government issued paper money in order to finance some kind of spending. And it issues a paper money, and as its holder, the holder has a financial claim on the government. You and I are creditors to the government by holding this IOU, this note. So he's going to talk about three different groups or three different, categories of people, entities that own the government debt. So when we say, who are we in debt to? One is going to be just paper currency here and around the world. Another is going to be foreign central bank reserves. The third is going to be the Federal Reserve. So number one, paper currency around the world. Each of you viewers who have the currency of any government in your pocket, in financial terms, you're creditors to the government whose paper currency you're holding. And that makes you, in effect, a creditor to the whole society. You don't think of yourself as a creditor because it's not that financialized. But technically, if you look at the government balance sheet, assets have to equal debts. That's why it's balanced. So you have government debt, liabilities on the left side, and on the opposite side, the assets. Paper money is a big chunk of this. And if the government would repay this paper currency, presumably by giving you something in return, there wouldn't be any paper money left. So of course, the government's not going to pay this paper money. So think about this, going back to when we had a gold standard, it was $20 and I believe 46 cents per ounce of gold. The gold was what the IOU was for, was what the dollar bill was for. And dollars were measured in gold and could be exchanged for gold. So there was something backing the dollar so that if you were to turn in $20.46, I'm going to say $20 from here on out because I'm pretty sure it's 46 cents, but I might be a few pennies off there. But let's just say $20 because that's what everyone knows. If you bring a $20 bill to the Treasury, they would give you an ounce of gold. So that was the exchange. What would they give you now? There's nothing to give. It's not backed by gold. The other side of the equation used to be gold. Now it is the full faith and credit of the US government. But that doesn't mean anything. So if there was anything backing this dollar, if there was a debt that could be repaid, you could take dollars and go to the Treasury and you could get what that IOU is for. But it's not for anything. It's for the continued government spending. It's the privilege of being the world reserve currency. You get the ability to have other countries just transacting in this stuff with nothing on the other side. And then you get into the military's role in defending the dollar. You get into the fact that countries are strong-armed into having to use dollars or get benefits. We can offer benefits by using the dollar by continuing to be able to create more and keep paying people. So run through that again real quick. You don't think of yourself as a creditor because it's not that financialized, but technically, if you look at the government balance sheet, assets have to equal debts. That's why it's balanced. So you have government debt, liabilities on the left side, and on the opposite side, the assets. Paper money is a big chunk of this. And if the government would repay this paper currency, presumably by giving you something in return, there wouldn't be any paper money left. So of course, the government's not going to pay for this paper money. It puts it out there with the expectation that no one will go to the Treasury and exchange it for what it's worth because it's no longer worth anything. There's no gold. There's nothing on the other side of that exchange. It's an accounting trick. The government debt is an accounting trick because it is balanced in that there is an asset holder, there is an investor, there's someone holding the other side of the debt, all 36 or whatever trillion dollars, there's someone holding that, but no one's going to go to the Treasury to exchange that. The whole idea is you just exchange it amongst yourselves. And as long as we, the government, the US government, can continue to create that money out of nothing via the mechanisms we talked about, that is the privilege of the world reserve currency. But there's no intention, there's no ability to pay out the debt, because what do you pay? What are you going to pay out? If they were to reduce the debt, they're just reducing dollars existing in the world. Those dollars are the other side of the coin. So if you turn them back to them, I guess they would just be sitting on dollars, but then now they're sitting on their own IOUs. Like, again, it's kind of an accounting trick. So you think of this money being spent for what you buy, especially in small amounts. It's a grocery store or other similar venues. We have this idea of money that we have to separate from actual macroeconomic global reserve banking. Like, when we talk about debt, we talk about bad debt, good debt, productive debt, destructive debt, however you want to, categorize it. But we have this obligation to pay our debts. We have a way of thinking about on the micro side that doesn't really apply on the macro side. And that's why these terms can be misleading, and why Noah was asking, like, why do we even call it debt if it's not going to ever be repaid? That's a good question, but the term is technically the same, but it has a different meaning when we're talking about something other than what we're used to with our personal understanding of debt. So you think of the money being spent for what you buy, a grocery store, similar venues, but actually most US currency is held in $100 bills, large amounts. Often they're packaged together in shrink-wrapped large bundles that are photographed being transported out of US aircraft and paid to the dictators and the kleptocrats and politicians that we're buying off. So this gets us back to US aid, for instance. We see this money being hemorrhaged and wasted, squandered on the most pointless, often evil expenditures, the things we covered before, our fraud, waste, abuse episode. When you see the list of things that US aid is spending money on, these things that Doge uncovered, all of this wasted money, we knew it was wasted, but we maybe didn't know how bad it was. And that was pretty eye-opening to see how atrocious these spending efforts are. We see that as fraud, waste, and abuse. We see that as mismanagement of our money. Central banker sees that as keeping the dollar. Like, we have to get these dollars into the hands of the key players around the world so that they use and depend on them and trade amongst each other so that we retain this. And so I remember, the Obama, the C-130 full of pallets of cash going to Iran, and you get furious about that. The Doge efforts, the US aid, wasted money, to them, from their perspective, they want the dollars circulating around the world because they need other countries to continue to use dollars. So how do you get dollars around the world? Congress couldn't, pass a bill saying we're going to drop a truckload of, a plane load of $100 bills, pallets of money in a country that we're notionally at war, not at war with, but just quote an enemy. That would never get approved. They could never do that. So they just do it in secret. But the goal is to get the dollars elsewhere. That's why pallets of cash just get, shipped all over the world. That's why money gets flung, fire hose all over the world for pointless causes. It's because the dollars need to be out there. So he says most $100 bills and most US currency isn't held by Americans, it's held by foreigners. So this US debt is the savings. This is key here. This US debt is the savings of a large portion of the world's kleptocracy, and also just people trying to look at the US as a safe currency compared to what they have. They certainly have more faith in US paper currency than they have in their own foreign currency. And this money is considered for saving, not spending. So there's number one. Paper US dollars held some degree by us, but mostly by other foreign actors to get the dollars out in the world. The US debt is the savings of a large portion of the world's population. He says kleptocracy, but I'll just say population here. When we understand that, we can kind of get our first understanding of why the US debt will never be repaid. Because what does that even look like? They're using this as an asset. They want to save it and store it and grow it, invest it, whatever. They want to keep this money in motion or just hoard it and trade amongst each other because it is, every other country sees it as a valuable asset. So what are they going to do? Just come to the US Treasury and exchange it for what? Those dollars aren't going to be repaid. So part two here, after the paper currency around the world, is foreign central bank reserves. So he continues, the second category of U.S. debt is sort of like this. It's the debt that's held by foreign central banks. It's their currency reserves. And you can look at the Treasury Bulletin every month. The Treasury Bulletin lists who is the U.S. debt owed to, who owns Treasury securities. Well, a huge chunk, sometimes 1/3 of the entire new issue of foreign debt is owned by foreign central banks, especially a few decades ago when military spending was very high. And that's the essence of the dollar standard, which I call the U.S. Treasury bill standard. We had a gold standard. Now we essentially just have a dollar standard. Dollars exist and are traded for the sake of them being used because they're liquid, because they're tradable, because they're valued by the world. Since 1971, when President Nixon stopped paying deficits in gold, foreign central banks don't really have an international asset that they can hold apart from US dollars. So instead of General de Gaulle and the French being able to take the dollars that they're getting from the US, spending in Vietnam and Southeast Asia in the 1960s to buy gold, now all they could do is buy US Treasury securities because they're not going to get their gold. There's nothing to get. The other side of the balance sheet is just sort of this empty, it has value. We still use it. We're all going to be paid in them. So like there is value, and you can take those dollars and convert them to tangible assets. You can convert them to the things you want, goods and services. You can, earn them, optimize them like we teach you to do, and live that life that you want to, right? So there is value to them. There's just not value in the sense of settling this debt, this IOU to the Treasury. They're not going to give you anything in return. These dollars are going to stay out there. So he goes on, and these Treasury securities that foreign governments hold are to finance a U.S. budget deficit that's result largely of U.S. military spending to create the 800 military bases we have around the world to surround countries and sort of force them to not abandon the dollar standard. But they're financing their own encirclement and their own basic U.S. military buildup around them. And that makes the foreign debt to U.S. central banks a free lunch. The U.S. can just spend as much as it wants, and they do. The dollars that it spends ends up in the foreign central banks of Europe and also China. And foreign central banks don't have an alternative unless they're to use these dollar inflows and buy gold or something else. And of course, if they do that, the United States declares them an enemy for trying to de-dollarize and essentially declares financial war on them. If you look at the list of the countries that didn't have a central bank 20 years ago, they're all the lists that they're countries that we've either invaded, destabilized, ran a coup on, eliminated their leader. It's a very familiar list, the countries that didn't have a central bank, and now almost all of them do. I believe North Korea is one of the last ones that doesn't. But it's the idea, like the military's role, clearly it's not defense of America. If it were defense of America, they'd be concentrated along our southern border, but they're not. We have 800 bases around the world in 120 countries, I believe, and we are ensuring that countries continue to use the US dollar. And that benefits us. Again, I'll say it over and over. Like, we might not like that philosophically, but we do benefit from that. So, if you want to continue to be able to buy a new F-150, regularly when you want it, if you want to be able to move into we have the standard of living here is off the charts for most of the world. And so, of course, we benefit from that. And we have to understand that. Foreign central banks don't have an alternative unless they're to use these dollar inflows to buy gold or something else. And of course, if they do that, the United States declares them an enemy for trying to de-dollarize and essentially declares a financial war on them. This free lunch is something that nobody expects to be repaid. The U.S. is not able to create enough of a balance of payment surplus to pay Germany and France and China and Russia and Japan all of the securities that it owes them. So it's not going to repay them. Well, let me spell out just how this system works. Suppose you go to the grocery store and you buy food and other household items. Let's suppose that you do what the U.S. government does. When the cashier prints your receipt for $30, you sign an IOU. You just pull out a piece of paper, a little sticky note. He says, I owe you $30, and you put your name on it. Well, that's not a credit card. That's just you writing a note, a signed note, an IOU for $30 to the store or whoever would be the bearer of this note. Well, the manager would come to you and ask you, what am I supposed to do with this IOU? And you would tell them, well, you can use this $30 IOU to pay whoever you buy produce from, whoever you're buying milk from. You just pay them in check, and then you give them my IOU for the rest of it and just let it circulate around, and it'll circulate and everyone will trade with it just like they trade a dollar bill or a bank check. It's part of their assets, right? If you told the grocery store manager that this little piece of paper that I have, I wrote on it, I signed it, it says I owe you $30, I'll give you the $30, but rather than me just giving you the $30, why don't you just take this, and when you need to go spend somewhere, if a customer needs change, if they buy their groceries and you owe them $30 of change, why don't you just give them this IOU? It'll circulate around the economy because everyone knows that this IOU coming from me with my signature on it is worth $30. So as long as people trade this IOU for $30 as if it were $30, if it had the purchasing power, the transaction value of $30, what does it matter? Why do you need me to give you my $30 when I just give you this? If other people will take it, what's the problem here? So he says, well, obviously that's not how the world works for you and for other individuals, but it's how the international financial system works. When the U.S. spends money abroad, and military spending is by far the leading category of the U.S. balance of payment deficit, that is pumping dollars into the world economy. The recipients of these dollars in foreign countries will turn these dollars over to their central banks in exchange for domestic currency because they operate their business in domestic currency. Okay, so the U.S. government is saying, hey, we're not going to give you anything, but we'll give you this IOU for $30, you foreign central bank, and then you will hold on to that, right? And so that gets back to, it's a different way of thinking about it. It's a different way of describing of how we think about the word debt, of how we think about owing something. Like when we owe something, we understand what the obligation is. If we have the mortgage, we understand that I need to earn dollars to turn over to the lender in order to fulfill the terms of my note. Like that's where the disconnect is. There's no fulfilling the terms of this note here. This is just the IOU circulating around the world. Back to the article, and the central banks then have these dollars. It's what they call their international foreign reserves or sovereign wealth fund. It's invested in U.S. Treasury bills. When the oil war happened in 1974 and the OPEC countries quadrupled the price of oil, they were told you can charge whatever you want for oil, but you have to keep all of your savings, all the receipts you get from this oil, you have to keep that in U.S. currency. That's the petrodollar. We're not going to let you buy U.S. companies, but you can buy stocks and bonds. You have to put it back into U.S. banks to buy Treasury bills. You can't really spend it for anything. You're stuck with it. And if you don't do that, we'll treat that as an act of war. That is the 1970s oil petrodollar system. So foreign countries count these unspent dollar receipts as their monetary reserves, just as a store owner might count your $30 IOU as part of its assets on a balance sheet. If people are willing to trade in it, why not? Just hold on to it and circulate it around. From their perspective, we have an asset. It's listed on the balance sheet of that foreign central bank as a receivable, an account receivable, or an asset. The free ride for the U.S. government is what has led other countries to want to de-dollarize their economies. That's what the BRICS are trying to do, and Russia has already done it. If it holds any U.S. dollar securities now, after maybe the worst foreign policy decision in our lifetime was freezing and confiscating Russian assets in 2023, I think $300 billion that they just froze. And the rest of the world saw that and said, hey, wait a second. We've been operating under the assumption for decades now that these are safe, secure, backed by the full faith and credit of the U.S. government. But we just watched Russia get their $300 billion just stolen from them. And so now, wait, we have to hold these treasury bills. There's value in them because other countries will accept them, but other countries only accept them because they value it as an asset. If that stops, I don't want to get stuck with these, right? And so the de-dollarization efforts around the world are leading to this idea of trying to replace the dollar as a world reserve currency, because we proved, Biden's administration proved, these aren't as stable as you think they are. Even though we all know the game, we all know there's no exchanging these for anything of value. The value is in that we will all take them. We all know the game. We all play that game. We don't really have a choice. But then we just shattered that illusion that these will always be tradable, because if we can just confiscate them, that's a huge red flag to the rest of the world. And so that's why essentially Russia has severed its dependence on the dollars. China is worried that the United States may do to it what Russia has done to America, or what America has done to Russia, and simply grab all of its money at a point. But it's hoping somehow to be friends. So like now there's a lot of these efforts right now that are kind of playing out in the trade war, in the effort to reestablish or maintain the world reserve currency status. I think that a lot of underlying what we're seeing in the headlines right now, there's a lot of this that is important to understand. Okay, so that's number two. That is the foreign central bank reserves around the world. We have paper currency held by us, held by foreigners. We have other central banks around the world holding treasury bills as a stable asset, possibly until we discontinue that illusion by seizing Russian assets. Now we're on to the third group that he's going to cite when we say, who are we in debt to? We're in debt to the dollar holders around the world with paper currency. We're in debt to the central banks around the world who own treasury bills as part of their valuable reserve assets. And the third one, this is back to that weirdness. The third one is the Federal Reserve. He says, we can discuss this debt later, but that isn't the only debt the United States government has no reason to pay. A large and growing debt is owed to the government's own Federal Reserve. If the government wants to spend money into the economy, it asks the Federal Reserve to buy U.S. Treasury securities. So the Federal Reserve owns these securities, and the banking system owns U.S. securities as backing and reserves for its own deposits and loans. That's how banks work, by holding reserves. So this part of the U.S. debt also isn't supposed to be paid. And there's no way that the U.S. is going to go bankrupt. If the U.S. had no debt at all, there'd be no government debt to hold as bank reserves. There'd be no reason for the Federal Reserve to exist. You can see the problem. So all three of these entities, the Federal Reserve, foreign central banks, and holders of cash around the world, don't expect to be repaid, because if they did, we're reducing the dollars that are out there circulating in the world, and doing so reduces the value of we need this sloshing around the global plumbing constantly. It has to continue if we're going to maintain reserve currency status. And so I think this fact that the Federal Reserve, an own quote branch of our own government, is one of the owners of the debt, like that is where it just gets really weird. And that's why I say it's kind of just this bogus accounting trick. I'll continue here. So just like the paper money in your pockets, this other Federal Reserve holding, foreign bank holding of government debt, those three are not expected to be repaid. And I think this kind of financial maneuvering shows that the United States doesn't really have to borrow. It can really, in effect, just print the money. Big point here. But when it prints the money, this money it prints, just like issuing paper money, the money it prints is counted as a debt to the Federal Reserve. So it's all a wash transaction, sort of the illusion of a debt that is somehow in trouble. Key takeaway there. When the government prints money, it's counted as debt to the Fed. He says, if we can get all these categories of the U.S. federal debt out of the way, then finally we have the kind of debt that most people think of. The treasury bonds that are notes that are held by individuals, especially the wealthiest people. The wealthiest investors all have substantial holdings in U.S. securities, the bond market. There's been a flood to the U.S. debt as a safe haven asset. Now, here's where he's talking about, because the premise of this discussion was the U.S. is not going to go bankrupt because it can't. And so we're taking that premise and the point that they're trying to make here, whether or not we agree with that from our perspective, this is the crux of the argument that he's trying to make. Just as Congress is saying, warning, the U.S. is near bankruptcy, Wall Street and the large investors and foreign investors too are calling the dollar a safe haven. That doesn't sound like bankruptcy. They're moving out of stocks and bonds, out of other assets into U.S. debt, because as the U.S. economy gets more fragile and top heavy, they know that the U.S. government can't go bankrupt because its debt is all in its own currency. It doesn't owe foreign currency debt that it would have to print like other central banks do. It owns debt in its own currency, and it can print as much as it wants. This is basically what modern monetary theory is. Now, I don't agree with it, but when we need to understand how they view it. And it's not just that they're like hardcore leftists and socialists for the most part, but it's not just that that's what they are and therefore their opinion is invalid and modern monetary theory is, this bogus theory. Like, this is the theory. The theory is that the debt can't be repaid. It's not supposed to be repaid. It never will be repaid. And that's not a problem as long as the world wants these dollars, because we can continue to produce them and supply the world with what it wants. That is the crux of the theory. All right, continuing on. If you go to the bank or the Federal Reserve and say, here's my $20 bill, I want to cash it in for money, they can give you two $10 bills, but that's all you're going to get. Despite the enormous magnitude of the U.S. federal debt and the loud warnings of government insolvency when the sky's falling, the Treasury bonds are still viewed as the most desirable safest asset around. Now, the third part of our Know Your Enemy series I was talking about, so guys falling, like we have to get this spending under control. Again, there's those two inputs though. There's the interest rate on the debt. We want that to go down so that we can actually pay it. But if we don't stop the spending, so I think the financial sky is falling because I just don't buy that this can last forever. And I think that in my example earlier, $100 of debt, whether it's 3 or 10%, that rate doesn't matter too much if the amount that's being compounded keeps growing. If the principal is ever expanding, which it is, at a certain point, people are going to lose faith in this. But right now, again, I'll give them the premise that so long as the world demands dollars as its safe haven asset, which they still do at this point. Now, and again, Biden confiscating Russian assets that were denominated in treasury bills was a prolific mistake because that is going to lead to people not trusting and not wanting these. And if that happens, that is where the sky actually falls. But right now, people still want it, and so I think they're in a sense correct that is if this demand continues, they can continue this system, and that's clearly what they're doing. They believe that that's exactly what's happening, and so there's no reason to doubt their sincerity on that because so far it has been working to it in a sense. So despite the magnitude of the federal debt and the loud warnings of government insolvency that the financial sky is falling, the treasury bonds are viewed as the most desirable, safest asset around. Chinese officials have told me that they don't expect the US dollar to go down. They're reducing their holdings of dollars in favor for gold and other foreign currencies, but they're still holding enormous amounts of dollars because they expect them essentially to remain a strong currency. So basically, the enormous increase in wealth that the wealthiest 10% of Americans have made since Obama bank bailouts in 2008 stem from the fact that the US debt has been thrown to finance and created the largest bond market boom in history. This bond market boom has only benefited the wealthiest financial classes. So here's wage levels and income for the bottom 90% flat. For the top 10%, it's gone up and up. Now, again, once they start talking about the 99%, the 1%, like the victims here, I don't believe in victimhood. Like whatever they're doing, your outcome is on you. And so I tune out when I start hearing about this, class struggles here, or whatever, like the exploitation. That sure that this happening to a degree, but honestly, let's be real. In America, we're doing pretty good now. Our savings is abysmal. Our wages have not grown, but that sentence that he said there, like strip away, in my opinion, strip away the whole like the 90% versus the 10%, strip all that away. But wage and income levels for most people is flat, while for the top 10%, it's gone up and up. My takeaway from that is that's how it's felt the last couple of years, where the economy can be crashing, but the stock market keeps rising, right? So 2020, 2021, we're like, how is the market still going up? I was shorting the market. I'm thinking like, all right, the train is off the tracks here. Like we are over the edge of the cliff and we do not have a parachute. Like this is insane. Supply chains, just the overall macroeconomic environment can be going haywire, but the stock market's like, how does that keep going up? And again, that's the financialization of the economy. So his final point here that I have from the transcript is all of this is financed by government debt, turning the stock and corporate bond markets into a Ponzi scheme. So this is a bright side of government debt and why you shouldn't be frightened in having to solve it. So the question is, what is the motive of people trying to frighten people about government debt? Now, that's me and Brian. That's our IBC community. Like we are talking about government debt, and I think it is frightening. But this is the other side of the coin. They're not frightened by this because the demand continues. Michael Hudson teaches universities in China, and despite how we frame China as being communist, America being capitalist, what capitalism has become, this financialization of the economy, that is not capitalism. Like industrial capitalism, the production, free markets determining wages and prices, this kind of utopia idea is not what we have at all. It's not what we have. We had it, I believe, under the gold standard when there was something for those IUs to be traded in for. We don't have it right now. And so Michael Hudson teaches in China, and he says that they're trying to learn from our mistakes. They don't want to, become this like financial hollowed out, shell of an economy. So whether he's right or wrong on that, but he's getting information from Chinese officials, and they're saying that they're not getting rid of their dollar reserves to the degree that people are thinking they are. So with that in mind, I'm going to revisit some of the questions here from Noah. What incentivizes foreigners to buy our treasuries? the fact that other countries will buy from them, the fact that they can transact in them. It's like, why do we want dollars? Is because we know, I have faith that when I go to the grocery store, they'll take dollars. If I go to the Hotel Del Coronado here on the island, they're going to take dollars whether I want to buy a room or a cocktail, right? If I go to buy something on OfferUp and we're going to buy a piece of furniture or something, like, they're going to take dollars. If I go to a store to buy a shirt, they're going to take dollars. So the same reason that I want dollars is the reason that other foreigners want our treasuries, i.e. dollars. He said, what did they pay with originally? With their native currency? Yes, they pay with their native currencies. Foreign central banks hold reserves of most of the major currencies: dollar, yen, euro. They have significant amounts of these and they use them for trading, but they purchase them in their currency initially. But it's not just that, like, it's not that everyone's just buying treasuries direct from us. They're also trading them amongst each other. And so, like, there's this whole world. And again, that's why I said, like, these dollars need to be flowing through the plumbing of the world economy continuously in order for this system to keep working, so they can trade them amongst each others because they have value. Noah says, are these purchases limited to nation states, or can foreign individuals and companies hold them as well? I think we addressed that. You can go on as a listener, go to treasurydirect.gov and buy T-bills. You can buy 1 year, 3 or 5 year dated bills, just like buying a bond, a CD essentially. Like, you're just buying it, you're investing, you're becoming a creditor to the government. The government says, hey, we want to spend this money. We don't have it. We'll borrow it from you. We owe you, and we're going to pay you interest. We think about the fact that the reason the debt has to keep going up is because the interest on this is more than the dollars that exist. And so they have to continue to create dollars to pay the interest, right? If $100 is the total amount of money in the economy and more than $100 is owed out after interest, you have to create it, right? Because you can't pay everyone who's holding those dollars. You can't pay them all interest with the same pool of money. It has to continue to expand. Does foreign governments owning these pose a national security risk? Potentially. People have talked about, what if China just unloads all their treasuries? And I think that it's kind of a mutual gun to the head situation there. If they were to do that, I mean, that is the powerhouse asset, gold and U.S. treasuries for foreign central banks. And so to do that, you're kind of like, maybe you're bringing the whole ship down, like you're all going down with it, I guess. And that's a question that probably requires a lot more thought. And so I would say that with where I'm at, yes, there is a threat there. It could be a threat that a country could just have a coordinated effort to devalue these treasuries. But I don't know that that's necessarily in anyone's interest right now with the current system, unless they were to come up with a replacement. And right now, guys, BRICS is nowhere near the capacity we talk about the BRICS. There is like a coordinated effort to move away from dollar dependency. I don't think that even them moving away from dollar dependency is going to reduce the majority share that the dollar has in the world economy, but there is potentially a threat there. If I learn anything more on that, like an actual legitimately cited, threat, and walking through it, I will elaborate further. What's the passing debt ceiling legislation? It's to continue to allow this spending to increase. There's not enough dollars to pay the interest, right? If our national debt's 36 trillion, as they say, but then we know it's more like 200 trillion because of unfunded liabilities. Like, how are we going to pay every Social Security check? We're not taking that much money in, right? The government gets its receipts and then it owes much, much more than that out. That's the deficit. You either default on that. You say, hey, I just can't pay these treasury bills. They're not going to do that, right? From the conversation above, like, they're not going to default on this debt because they're going to pay that interest. That interest is going to be paid first, because the whole system is built on people continuing to buy and circulate treasuries. And so the purpose of the debt ceiling legislation, I think, is just to continue that system. It's like, that's always going to keep getting increased, because it has to be increased, because more interest has to be paid every year. Why is it a political talking point to reduce the national debt? Because it's a political talking point, because it sounds good, because we think of being in debt the way that we understand it. We think of someone with maxed out credit cards. We got to get out of this debt. That's not what it is. That's not the case here. Like, this national debt is the money out in the rest of the world. It is the dollars in the rest of the world. And if you think about what does that mean, like, we go back to the example of, I go to the Treasury or to the Fed, say, hey, I got my dollars here. I would like to exchange them for what they're worth. And they're gonna be like, what do you mean? They're just worth dollars. That's it. There's no other side. And if all the debt was to be repaid, there's no dollars left, because the dollar is debt. So I think it is a political talking point, and I think it's either intentionally or unintentionally misleading, because it's not going to get repaid. It can't with this system. Why do we call it debt if it can't be paid back? That's kind of the same question. And he says, the overarching question, if I had to sum it up, what's the threat of the national debt? Well, according to Hudson, the problem isn't the debt, it's the interest rate. relative to the receipts of the government. It's the accumulating interest and the ability to repay it that is a problem, not the debt itself. Again, that is kind of a summation of modern monetary theory, MMT. We don't really care what the debt is because we create the money. So as long as we can pay the interest, we can just continue this. The rising tide lifts all ships. Dollars become worth less as far as spending power goes. But as long as they continue to promulgate throughout the world and the demand continues, what does it matter? Okay, maybe a car costs $200,000 in 50 years, but now everyone's making more money. Like on paper, like the theory is of the rising tide with wages, with prices, moves up with the debt. Now we know that's not the case. It hasn't been the case for a long time, I don't believe, but that is the theory. And so he says the problem is not the debt. The problem is the interest on the debt and the ability to pay. And he says, they say, we maintain the ability to repay because we can just create the money to pay it. You know, it's a wash transaction. It's just bogus accounting. But I think that hopefully sheds a little bit of light on this question that a lot of people have, which is, why do you say that we can't ever repay the debt? That's because maybe it's not that we can't, it's that we won't, because doing that kind of tanks the whole system. I'm gonna wrap it up there. That's like an hour, so that's a pretty long one. But this is a really interesting topic, and I think that, again, understanding where they're coming from is critical to interpreting what's going on right now in the macroeconomic environment, because a lot's going on. And also, just, you can't sever yourself from something you don't understand. It's good to be doing IBC. It's good to be becoming your own banker. It's good to control the notes when you borrow. Like the policy loan is the most powerful credit instrument there is. Cash value is a more valuable asset than Treasury bill. I'll make that case all day because it's contractually guaranteed, because of the reserve bank. Like I think that cash value is the most valuable asset you can have as an individual, bar none. And we should be doing that, but we should understand why. And we still need to understand the sandbox that we're all in. We're building our castle here, but we still need to understand the enemy. So as always, know your enemy, and we'll see you next time. Cheers, guys.